Welcome to Operation Spring Tide. This video explores the convergence of the quarterly rebalance and quad-witching expiration, a dual force that can drive the biggest market flushes of the cycle. We are bound by rules and feared by trade. Before we begin, please note that this video is for educational purposes and market commentary only. It does not constitute financial advice. We analyze how institutions move size to help you read the tape. Always trade your own plan and manage your own risk. The core thesis is simple. Approximately $150 billion of global pension de-risking is hitting the market during a quad-witching expiration. Expect institutions to sell winners into strength and rotate from equities into bonds, while the inflation peak trade quietly bids on cyclicals. In this video, we will cover the operation from end to end. We'll start with the macro context, move into the mechanics of institutional selling, examine the current market rotation, analyze technical indicators, identify key names to watch, and finally, discuss the overnight plan. To summarize the setup, we are looking at roughly $150 billion in equity rebalancing, following 4 days of consistent institutional selling, occurring during a quad-witching expiration, while the market faces rejection at the 22-day exponential moving average. Our goal is to provide a timely market read, so you can understand institutional moves before they trigger. If you find this analysis helpful, please subscribe to our channel, hit the notification bell, and join our community. Moving to Section 1, the Great Rebalancing. We are looking at a massive $150 billion in global de-risking that is about to print into market liquidity. What exactly is a quarterly rebalance? Large allocators, such as pension funds and sovereign pools, hold assets at fixed target percentages. When a strong market moves these weights, they must sell stocks and buy bonds to get back to their plan, especially at quarter end. JP Morgan estimates billions in net equity selling for this quarter, marking one of the largest estimates in years. This global movement includes rebalancing across the UK and Asia, all occurring within the same window. We have to look back to 2023 to find a similar rebalance size. Quarters in between barely registered, but the current print is massive, which explains the current market action. This massive rebalancing is the driving force behind the market's behavior. We saw a taste of this volatility after the PCE data release, and we expect it to scale up tomorrow into the long weekend. This is a global event. In the US, the focus is on trimming mega-cap equity weights. In the UK, pension and insurance books are rebalancing, and in Asia, Korean and Japanese books will interact through the overnight session. This chart illustrates the so-called alligator mouth, representing the divergence in equity and bond holdings as a percentage of total assets for the G4 allocators. The jaws open wide when one asset class runs hot, while the other runs cold. Equity allocations are at their highest levels since 2001. While this extreme positioning isn't a trigger on its own, it acts as dry tinder, meaning there is significantly more stock for institutions to sell during this rebalance. Conversely, bond holdings are at their lowest levels in nearly 20 years. This configuration of maximum equities and minimum bonds is exactly what triggers a mean reversion, where institutions sell what is heavy and buy what is light. Institutional trading differs from retail. While you may seek to maximize profit while managing risk, pensions and insurers operate differently. Their goal is to hit an estimated target. As long as they are on plan, they are satisfied, leading them to constantly shed risk. This is the hurdle rate mechanic. If a plan requires 6% and the portfolio is tracking 8%, they are ahead of plan. They don't celebrate. They cut risk, sell the winners, and rotate into safer assets to lock in the plan's success. It is counterintuitive, but they reduce the things that are winning to buy something safer, because they have cleared their hurdle. This is the opposite of how a typical retail trader thinks, and it explains why market strength gets sold. The resulting rotation is out of equities and into bonds. They trim their overweight equity positions to build their underweight bond positions. This rebalance isn't just churn. It has a clear directional bias. While they have until the 30th of the month, the trigger is tomorrow. Quad-witching OPEX concentrates flow and liquidity into a single session, creating a collision of mechanical selling. Why call this spring tide? Like the alignment of the sun and moon creating an extreme tide, we have two forces stacking: a massive $150 billion rebalance, plus the concentrated liquidity of quad-witching OPEX. To summarize, a massive mechanical rebalance is meeting a quad OPEX trigger. With allocators at maximum equity exposure, the setup is primed for de-risking, where winners are sold into any available strength. Moving into Section 2, Mechanics. We focus on selling into strength. Large institutions don't unload billions when it's quiet. They wait to sell when retail is actively buying. When moving billions, you cannot wait for a technical level to trigger. You must exit when there is actual liquidity, which often means selling into the buying volume of others. Often, good news provides the exit door. Whether it's positive economic data like PCE or a blowout earnings print, these events pull the buy the news crowd into the market, providing the necessary liquidity for institutional distribution. Observe the tape. We have seen 4 days of consistent, methodical selling. Instead of volatile bursts, this is steady distribution that allows the market to absorb the flow, which has become increasingly heavy. We all felt the change in momentum recently. There is a distinct difference between background distribution and the days when institutional sellers aggressively lean into the market. Why no reliance on specific levels? Large size needs a counterparty. Technical levels rarely have enough resting liquidity to absorb billions, and triggers are often too late to provide an efficient exit. The pattern is consistent. Names get bid up into the rebalance to draw participation, only to be walked back down in the subsequent session. Chasing strength on great news is currently the most dangerous position. The island reversal is the fingerprint of this activity. Price gaps up into a zone, is rejected, and gaps away, leaving a stranded island of price action. It is a clear sign of distribution, not accumulation. Moving to Section 3, Rotation. The market is voting that inflation has peaked, and savvy traders are following the money. Let's look at what the smart money is buying right now. When the PCE report was released, a strange thing happened. Home builders surged. While it might seem odd at first, it signals that the market believes the inflation fight is nearing its end and is pricing in cheaper money ahead. This is all about the interest rate cycle. As inflation peaks, rate cut expectations rise. Because builders are highly sensitive to the cost of money, they are the first to rally when the bond market signals a shift toward cheaper debt. Biotech is also waking up. Much like home builders, this sector consists of long-duration, cash-burning growth companies. When rates fall, their future cash flows become more valuable today, causing the entire group to re-rate. Crude oil is the ultimate tell for the entire inflation story. If you watch the price roll over, you're watching the inflation thesis roll over with it. It's an anchor for the broader market. Think of it as a chain reaction. Falling energy costs lead to easing input costs, which result in cooler inflation prints, higher odds for rate cuts, and finally, a bid for duration-sensitive and cyclical stocks. We can see the proof in gas futures, which are trending nearly 8% lower into June. Wholesale prices are already falling, even if the price at the pump lags behind. Because fuel is their biggest variable cost, airlines are a perfect inverse play to inflation. When crude oil drops, their margin story flips, which is exactly why the JETS ETF is currently ripping. Beyond just airlines, the broader travel sector, including cruise lines like Carnival and Royal Caribbean, is benefiting from the same theme. Cheaper energy is a major tailwind for all travel-related names. Cruise lines serve as a high beta expression of this trade. They carry significant fuel exposure and are highly sensitive to consumer sentiment. When the inflation narrative shifts, these names respond quickly. Despite the headlines claiming the consumer is broken, the retail sector is holding up surprisingly well. If we were truly on the edge of a collapse, we would see weakness here, but the data tells a different story. This resilience in retail rules out a major growth scare or a credit event panic. What we are seeing instead is a tactical repositioning of capital rather than a broad-based economic recession trade. The current mini-cycle is playing out in 3 stages. First, institutional selling punishes the index. Second, value sectors catch a bid. And throughout, cyclicals and duration are quietly accumulated under the hood. To wrap up our rotation map, capital is flowing out of crowded mega-cap equities and software giants, and moving into bonds, home builders, biotech, and travel-related cyclicals. Finally, we move to Section 4, Technicals. We'll analyze the index reads, specifically looking at island reversals, the bearish cross on our moving averages, and why the 55-day line remains the critical support level. This video outlines the 12, 22, and 55 exponential moving average framework. The 12 EMA acts as our day trade lens, the 22 EMA serves as our swing lens, and the 55 EMA represents the institutional line. Understanding these levels is crucial for determining market support. Focusing on the 12 EMA, this tool is strictly for day trading, governing a horizon of 1 to 3 days. It is not intended for swing trading. Long-term positions are generally exempt from this time frame. The 22 EMA is our swing trade line. When price is above the 22, bulls are in charge, indicating a live swing environment. Conversely, trading below the 22 indicates that bears are in control. The 55 EMA provides essential institutional support. Losing this line indicates that you have lost that institutional backing, often marking the difference between a healthy pullback and a significant trend change. A bearish 12-20 seconds cross, where the 12 rolls under the 22, acts as a momentum indicator. When combined with an island reversal, it signals that the environment is not suitable for long swing trades. Looking at the QQQ, we observed an island reversal with immediate rejection at the open. Being below the 22-day structure keeps our technical outlook clean and bearish. The NASDAQ 100 shows the same fingerprint, with an identical island reversal gap. This confluence across two major indices suggests persistent selling pressure. Prices tested the 22 EMA 3 times and was rejected each time. This pattern of repeated failure highlights the importance of following the market's current direction. We did not see the expected undercut and flush set up today. It appears that downward pressure may have been deferred to a future session. Our technical target remains a flush down to the 55 EMA. We are maintaining patience and waiting for that level to provide a cleaner opportunity. Regarding QQQ levels, watch the 700 put wall, which acts as a dealer support zone. The 703 level serves as the first marker just above that wall. It is critical that the QQQ does not close below 692.89. A close beneath this level serves as our primary bearish confirmation. Volume confirms our distribution analysis. The selling has been consistent over the last 4 sessions, with heavier volume today, particularly during the rebalance window. With the NDX average true range around 100-point moves are normal. Ensure your plans account for this volatility rather than assuming it cannot happen. In summary, we see a bearish 12-20 seconds cross and island reversal on both QQQ and NDX. We are trading below the 22, targeting the 55, and monitoring the 700 put wall and the 692.89 line. Moving into our next section, we look at market blowouts and breakdowns. The current environment shows that memory-related stocks are particularly influential, and we need to watch a few specific names closely. Micron serves as an example of a significant market blowout. The recent print and guide were not close to expectations, confirming our bearish outlook. We will provide a complete breakdown of this move on Saturday. A shift is occurring. Memory now sets the price. With 16 contracts recently signed to lock in availability, it is clear that pricing power has moved up the stack from the hyperscalers to the suppliers. When analyzing the same name, your time frame changes your trade. A 3-month hold requires looking past short-term volatility like quad witching, while a 2-day trade requires careful risk management based on your immediate horizon. Looking at SanDisk, chasing the close can be dangerous. The stock ran 10% off its lows and closed at highs, but given the 200-point average true range, traders chasing here face significant overnight risk. A critical theme is to avoid convincing yourself that your specific software name is special. The recent, brutal selling across the sector is an institutional decision that ignores individual sentiment. NVIDIA recently broke its 200 dealer put wall. This move removed a significant floor of support, leaving the stock vulnerable to further downside until it finds the next shelf of support. NVIDIA also presents a classic head and shoulders pattern. We have a left shoulder, a head, and a weaker right shoulder retest, with the neckline serving as the critical line for a potential further breakdown. In Palantir, we see a declining 200-day moving average, which is significant because it requires sustained institutional selling to achieve. The chart shows a head and shoulders pattern with a potential 28% measured move. When measuring potential targets, look at percentages rather than just points. For Palantir, a 28% move from the pattern aligns precisely with the break, which is a noteworthy technical confluence. Netflix is currently sitting at its 200-week moving average. This is a major technical confluence point, and it serves as a reminder that only institutional size can move a name like this. Regarding Oracle, long-term holders are facing a difficult reality. The current price action is showing consistent, unrelenting selling pressure that has resulted in a significant move downward over the past 3 weeks. For Oracle, the 200-day moving average is the next major test. Losing this level would further confirm the theme that institutions are currently rotating out of the software sector. Microsoft is also showing signs of distress. The technical picture is not stabilizing. It is deteriorating, which is consistent with the broader shift away from mega-cap names. Finally, Amazon's momentum has turned lower, marking another mega-cap losing its primary uptrend. This is part of the broader punishment we are seeing across the hyperscaler group during this rebalance period. We are moving on to the final section, focusing on Meta. As we've discussed, it's essential to filter out the noise and identify which names are truly struggling compared to the rest of the market. Meta's chart is currently described as a, quote, dumpster fire. Given the chaotic nature of its recent price action, it is not a focus area for our current strategy. It is best to avoid trying to trade within this level of wreckage. The core lesson here is to prioritize names showing relative strength and ignore those that are clearly falling apart. Do not waste your efforts trying to fish for value in the middle of a disaster. Not everything is failing. Google recently tested its put wall and held. This is exactly the kind of resilient behavior in a large cap name that warrants attention, while the broader index flushes. When a name holds its put wall, it suggests that dealers are actively defending that level. This defensive behavior makes it a priority name to watch when other parts of the market are under heavy pressure. Dell is another example of a name showing relative strength. It approached the 400 area, faced significant downward pressure, but ultimately reclaimed the level instead of breaking it. This pattern, wicking down and reclaiming a level, is what we look for when screening for strength in a weak tape. It shows that buyers are present at critical support zones. There is a debate about whether hyperscalers or memory suppliers are in control. The conventional view suggests hyperscalers, but the latest data from Micron implies that the leverage has shifted. Micron's perspective is that memory suppliers are now the ones signing contracts and dictating pricing. This confirms that the leverage is moving, a critical detail for sector analysis. When we sort our names, we categorize them into those to avoid, those signaling a breakdown, and those showing strength. This helps us maintain clarity in a complex market environment. For the overnight segment, the Korea trade has recently inverted. Traditionally, we would distribute into the Asian session, but now we are seeing the US bid up Korea, which is an important signal. The EWY Korea ETF and DRAM are deeply linked. Watching how they trade during the 8 p.m. session allows us to front-run how memory and semiconductor stocks will likely open in the US market. Regarding our posture, patience is required. We are not looking to be heroes. We wait for the market to confirm its direction, ensuring our actions align with the technical reality we see on our charts. To recap our strategy, we are accounting for a $150 billion global rebalance, a shift away from software, and a focus on relative strength in names like Google and Dell while we target the 55 EMA. Remember that entries missing the mark are a part of trading. Stick to your rules, monitor your levels, and remember that our goal is disciplined execution. Check our links below for more updates.